Welcome, market participants, to our second quarter forward look. I'm Van Hesser, Chief Market Strategist at KBRA. I'm joined today by our European macro strategist, Gordon Kerr, sitting over in London. Gordon, welcome to our second quarter forward look.
Thanks, Ben.
So let's pick up on the topic that I think is at the top of every investor's mind these days, and that is the conflict in the Middle East. Uncertainty is back. We're trying to dimension what that uncertainty means in terms of financial markets. Gordon, what are you seeing in Europe in terms of the credit markets anyway, and maybe also in the sovereign markets with investor reaction to what's happening in the Middle East?
You're right to point out the sovereign picture there. In terms of credit markets, credit spreads have moved a little bit wider, but not dramatically so. They moved wider and have since come back, similar to what we've seen in the equity markets. They haven't come back to their tights, but they've certainly returned to tighter levels. The picture on the sovereign side, though, is a little bit different. The risk of a rise in inflation and, as a result, a rise in interest rates has moved yields broadly wider. So, as a result, the all-in picture of yields has moved into a position where they are relatively attractive versus equity yields at the moment. When you incorporate that spread element as well as the element of higher yields from the various different sovereigns, you get a picture which showcases the relative value that credit offers in this environment. And what about you, Van? What are you seeing from the Middle East impact in the U.S.?
So when we think about the pain threshold today, it's far greater, in our opinion, than $100 a barrel. Will that tax of higher energy prices affect less wealthy households and more vulnerable businesses at $100 a barrel? For sure. But in terms of the broader economy, there's much more resiliency uh, to where oil is priced even today as it moves higher. We really start to get more nervous about this at $150 a barrel and up. And of course, the most important thing that we all have to factor in is duration of that higher price. Again, if we look back in 2011, 12, 13, we had $100 a barrel oil for several years, and yet economic growth was still relatively solid. So again, in and of itself, we don't worry so much about where oil is priced today. It's the uncertainty about where oil could go that has it on our list of things that we're watching closely as we head, obviously, in the next quarter.
Yeah, from our side in Europe, it's less about the individual. When we compare it to the Russia crisis, the Russia-Ukraine situation, where natural gas spiked quite dramatically, this is very different. It's a bit more of a broad-based impact on Europe, and it is having a greater impact, I think, than what you're seeing in the U.S. In particular, I think the focus is a little bit more on the consumer at the moment. So the consumer is still adjusting from the impact of the pandemic and inflation associated with that. And then they were hit with the Russia-Ukraine and the impact of rising energy prices then. So the consumer is a little bit more wary, and we've seen that come through in price expectations, 1 year forward expectations for consumer prices. They've recently spiked, admittedly, just for the month of March that we have the data for, but those expectations could feed through and would be a concern for in particular the central banks, and we've seen that in their language trying to target really. The language is targeted at trying to contain that consumer interest in seeing the secondary effects of the rise in the price of oil. Um,
Yeah, so Gordon, I hear a lot of the stagflation uh, term come back into describing sort of the outlook for Europe. Obviously, it's kind of the worst of all worlds for bondholders. I assume that the inflation part and the growth part are both very much something that you're going to watch closely in the second quarter.
yeah, absolutely, and I think there is a growing differentiation as well between the way that the European Central Bank is looking at this versus the way the Bank of England is. Admittedly, they're both on pause currently as we are recording this. But we'll see how they react in the near term, I guess, as we get more data and more information on how it's filtering through and impacting the economy. But keeping on that consumer element, in your forward look, you outlined an impact on consumer spending. Maybe you can highlight what you're seeing there and what you expect.
Uh, for sure, Gordon. I think with the personal consumption accounting for 65 to 70% of U.S. GDP, all things really begin and end with the U.S. consumer, and so we focus a lot on that in any given quarter. But I think we're especially attuned to what's happening now because you've got some headwinds that are mounting. Um, Even though we've seen historically low consumer sentiment readings, the University of Michigan, widely followed consumer sentiment survey, literally has hit its lowest point in its 74-year history, right? It's a remarkably pessimistic view of out of the U.S. consumer, and yet consumer spending has proven to be, I think, even in Chair Powell's commentary yesterday, he talked about uh, the U.S. consumer being remarkably resilient in terms of spending. We are starting to see, however, some again those headwinds we talked about, which would include a softening jobs market. So this no hire, no fire jobs market, I think, has created some anxiety among labor in the U.S. as again everyone is we are at or near full employment at the moment, but I think there's an expectation that the labor market could soften. We're seeing wage growth come down. We're seeing the threat of AI hang over how employers are thinking about adding to the labor force. And let's go back to the inflation side of things. Nobody likes inflation, including most notably consumers, right? So we're seeing those higher gas prices. We're seeing the effects of tariffs come through. Economists can argue about whether or not that constitutes inflation or whether it's a one-time price shock. The reality is the consumer feels that every single day. And so this really remarkable U.S. consumer, we are on the lookout for signs that consumer spending might be weakening. We think that's a very real risk for credit markets and risk markets in general as we head into the second quarter and beyond. How about from your perspective? Um, one of the things that I think was interesting in your report, if we go back to sort of that stagflation discussion, if we talk about the growth side of things, we're actually seeing a revival of manufacturing. Is that, I don't think I've ever said that about Europe in quite some time. Is that true? And do we think that's going to be durable as we go through all of these changes that we're anticipating?
Yeah, it's something that's come up through the PMIs, the Purchasing Manager indices, and so it has shown that they are in well, the net results come in over 50, which suggests expansion, and it's relatively broad based across Europe in terms of showing an expansionary manufacturing side. However, the services side has collapsed, and as a result, the overall number is not looking quite so rosy. But I think that manufacturing element is something that, should it continue and start to materialize, could help to support the economy in the second quarter and moving forward. And I think it's largely a result of actions that have happened in 2025. There was a lot of concentration on discussion around defense spending, infrastructure spending, and increased broad uh, uh, capital expenditure as well, related to the AI spend that you've just mentioned as well. So I think that overall, that picture is starting to bubble up in the background. It's a slow moving element of the economy, and it is starting to filter through, or at least showing early signs of filtering through. We will have to wait and see what the results show as we move into the second half of the year. But it is showing a at least a small bright spot in what is, as you highlighted at the beginning, looking to be a relatively stagflationary environment. On that AI front, actually, in your report, you highlighted the element of the AI promise and what it offers. Maybe you can just highlight to us what we can expect to see in that front.
Yeah, I think the AI story is so important economically in the U.S. So yes, we've got fairly solid economic growth, and yet it's narrowly based, right? It's the two growth engines are, as always, as we mentioned on the consumer side, the wealth effect coming from wealthier households. That obviously is dependent in to some degree on the buoyancy of the stock market. The other big growth driver has been tech capex, and they're related, right? Because of so much of the stock market is is driven by that AI promise, and so as we think through what the near term outlook and economic growth looks like, it really is dependent to some degree, to a large degree, on the AI promise that we've got to have the hyperscalers and other companies and end users have to continue to invest, which they have done so meaningfully in the recent past, have to continue to build out data centers, power sources. All of that needs to continue to support not only economic growth and the ripple effects through the economy that come from it, and those are substantial, but also to support that wealth effect in the stock market. So, we monitor probably every single quarter if that AI promise continues to be there. If we do show some cracks in it, um, yeah, I think that's going to have some real meaningful implications in risk markets. I thought, just as an aside, the market's reaction to Meta's earnings overnight where they continue to take up their investment in AI. And again, you can debate as to whether or not that's a positive or a negative. I think the market has viewed that somewhat as a negative in that this is becoming a big suck on cash coming out of the hyperscalers. But the alternative, the glass is half full, would say this promise remains intact. I want to continue to invest in it, continue to build out capacity because it is truly going to be transformational. So again, lots of different facets to the AI story out there, and it cuts both ways. And in any given quarter or year, we're going to have to, assess where we are in terms of its ability to continue to drive economic growth. All right. So on that note, let's leave it there. Again, thanks for tuning in today. I'd encourage you to pull up the full research pieces, Gordon's and mine, on our website. That's kbra.com/macro credit. We always look forward to the dialogue. Let us know what you think about the research pieces. Don't forget to check in on our weekly podcasts, available also on the website. We'll see you next quarter.
Thank you very much.